member of ASSOCHAM. He's from the side of ASSOCHAM, the industry association. He has joined us and he is going to formally welcome us as well as share some thoughts with us. And then he is going to pass on the mic to Dr. Virmani, who is chairing the session for today. So, Mr. Agrawal, please.
Yeah. Good evening, everyone. First of all, I would like to congratulate ASSOCHAM for conducting this seminar, Shadow Monetary Policy, Discussion on Monetary Policy. First, on behalf of ASSOCHAM and on my behalf, I would like to welcome Dr. Arvind Vermani, Chairman, EGROW Foundation, former Chief Economic Advisor, Government of India, and former Executive Director, the International Monetary Fund. He is very kind enough. He is always helping to ASSOCHAM, and whenever we need him, he is always there. So we would like to welcome him. We would extend our welcome to Dr. Asima Goyal, Member, Economic Advisory Council to the Prime Minister, Dr. Charan Singh, Chairman, ASSOCHAM National Council for Banking and Chief Executive, EGROW Foundation, Sri Indranil Sen Gupta, Chief Economist, India, Bank of America, Merrill Lynch, Miss Upasana Bhardwaj, VP and Senior Economist, Kotak Mahindra Bank. And we will also like to welcome Sri Abhi Barua, Chief Economist and Executive Vice President, HDFC Bank, and Mr. Raman Agrawal from FIDC, and all distinguished guests and audience from August gathering. Yeah, it's my privilege to deliver welcome address, and so I would like to thank ASSOCHAM. You see, on 8th August, on 6th August, RBI has going to give this monetary policy. So, what is status of our economy after COVID-19? There are various estimates from GDP 1.5% growth to contraction. And recent survey by, I'm just quoting survey conducted by Reuters poll of economics, 60 economists from July 20 to July 28, recent, very recent. What they said, economy is, they were earlier in their poll of April, they were thinking that economy will start recovering after first quarter, financial years, and from July itself. But now they say the condition is not conducive, and things will be not good, and they are expecting that the first quarter from April to June will be contracting 20%, and they are estimating the second quarter will be contracting by 6%, third quarter by 0.3%. So overall, they are estimating that GDP can go down from -5 to 7-8%. So though Prime Minister in a USA India Business Council, they referred that it's good time to invest in India, and there are green shoots seeing the economy in agriculture, freight collection, GST collection, and so on. So they have invited in various sectors to the businessman from US, and their feeling is that $40 billion can be invested in this year. So and assurance given, second reforms will be there, all type of reforms will be needed, and that will be done, and I think it's a welcome step for that Prime Minister, that inviting from businessmen from US and great FDI. So Reserve Bank official policy rate, which is as on today is 4%, repo rate, which is 58-year low. this 4%. If we go by 50 paisa, then it will be lowest since 1957 because it was 3.5% repo rate in 1957. So we are expecting that RBI, considering the status of the economy, they can go by 25 paisa to 50 paisa reduction in this repo rate. So, and uh, in last two policy from March to March and up May, they have reduced so far 115 basis point in repo rate. So and considering the inflation which is around 6%, it's a challenge for the RBI to reduce that kind of reduction. But still, government and economy required the kind of reduction in monetary policy because liquidity is required and industry is expecting the lower interest rate system. And what industry require restructuring of loan, one time restructuring loans to avoid any big time default, and support from many sectors like tourism, entertainment, travel. So they want these should be supported by the RBI or government. As bank rates, fixed deposits are increasing, so there is a low credit demand of considering this, RBI should go for lower repo rate by 25 bps. Now we are having experts from various field, and I think the session is going to be very beneficial for all. And before this, there would be opinion how much deduction should be there, whether it should be 25 paisa, 50 paisa, or more, or no more, or pause. So I conclude my remarks here. Thank you very much. And over to Dr. Arvind Varmani, who is the moderator of the session. Once again, I welcome all. Thank you very much.
Thank you, Mr. Agarwal. I guess we are all kind of learning how to conduct these web sessions. So I hope the listeners will excuse if we don't run as smoothly. But what I'm going to do is to give a kind of background and macro overview, both a domestic and a global perspective, and then kind of turn it over sequentially to the members of the committee as listed in the program to comment on the specific monetary policy issues, etc., and any other issue they want to touch on. So let me, some of you may be aware of these things, but I think it's very important at this time to take stock of what we have learned and what is going on across the world and in India. So the first thing I want to point out is that the pandemic shock is unique in the following sense, that it has had a combination of supply and demand shocks. Most shocks that we are used to in the macroeconomy, and I'm not talking just about India, but across the world, are generally fairly easily classifiable into supply and demand sides as they start. And there's maybe a little bit of mix-up in the middle, but then they soon clarify. I think this shock is quite unique in that sense that we have to keep both supply and demand aspects in mind as we go along, and I will illustrate that a little on. The second thing, hello, can you hear me? Hello?
Yes, we can hear you.
Yeah, okay. Because I seem to have disappeared from my speaking here. Anyway, the second point I would make is that, across the world, and of course India specifically, we are, one can say that the lockdown phase ended in July or sometime, in June or mid-July, and we are moving or have moved into the transitional phase. What this means, I will say in detail, but during the transition is really from lockdown to some kind of normalization. And I define this again, not just for India, but for every other country we are seeing this, that if we think of normal as 100 level of GDP and economic activity in an aggregate sense in December or January, December 2019 or January 2020, then 100 can be defined as roughly, plus minus 10% could be defined as a normal. And what we are seeing, we are seeing across the world is a particular curve, which basically shows that economic activity went down drastically to around and very sharply to around a 40 level. And then once the transition started, once the containment measures were removed, I think across the world they call these containment policies rather than necessarily lockdown, which is our favorite word. Then you had a pretty rapid rise to around 60, 65, and then again it's kind of got stuck there. And it's kind of useful to take stock of what happened is that basically it seems that the kind of two lessons which have not been fully absorbed or applied somewhat imperfectly or in a stop-go manner. One is the COVID specific lessons, which I'll come to. The other is something we have been saying from EGROW for several months, is that it is useful to think of economic activity separate from social activity, and economic activity in three sub-aggregates: the essential commodities, the contact services, and the manufacturing, mining, construction, and allied sectors. And this remains relevant because of the COVID lessons we have learned. So those countries which have mapped these sectors into the COVID lessons and applied them carefully and consistently seems to be doing better and will do better. Now, what are these lessons? Though this may appear not very economic, but I think it's very important to understand. These basically there are four or five lessons which we've learned about COVID, which seem to moderate, which seem to work. You have many countries and a lot of confusion across countries which are doing well, and they start doing badly. They have to go backwards and forwards. And in all this, there seem to be five lessons that at least I have been able to extract from whatever science is available and the countries have done. And these are, some of them are well known to you. One is hygiene and hand washing. Second is physical distancing, as I prefer to call it. Actually, I think this social distancing is a misnomer. It's a mistake. It actually causes more harm, because you really want actually more social closeness and the appropriate physical distancing. So hygiene, physical distancing, and the third one is not coming to me right now, but it will. But the fourth one is TTQ, which is those who have the testing, tracing, and quarantine. And the issue here is the weakest chain. Some people keep talking about testing, others talk about tracing, but it's really the weakest link in the chain. Those who have failed in the weakest link until they've strengthened that have not succeeded. So, but the kind of new thing we are learning, and which is very important, and it's important for business and all those businesses which are opening up the manufacturing sector, is that open air. Earlier we thought that masks. Yeah, the second one was very important. One is masks. I mentioned hand washing, masks, physical distancing, and TTQ. But the new thing, which kind of was known earlier, is that the mask becomes much more critical, and the virus is much more under danger in open air. We are safer in the open air. So, for example, construction, open air construction, open air mining in some sense is much safer and could have been opened much earlier, as against closed air conditioned spaces, because the evidence has become very clear that it is transfer is by air, and you recirculate, you have a closed space, and the intensity matters. So in a open air, if you're wearing a mask and somebody sneezes in front of you, as long as you have a mask, the virus will disperse. So this has lessons actually for the opening up also, that where it is air-conditioned spaces, where you are in an aircraft or airport or other such closed restaurant, hotel, closed air-conditioned spaces, you have to be very, very careful and open. Several countries, and we know this experiment has been done, many countries like UK and US who opened up without these very careful conditions on these things, then had to reverse. So let me leave it at that and continue. So I think it's very important for all business, for economists to keep these in mind when we recommend steps on opening, etc. And then let me go through 3 or more points which I want to make to come to the monetary thing. So basically now we are in a transition. Now coming in India directly, we are in the transition, and in the transition phase, what we had predicted that the supply chains and the movements would be very important, and you would tend to get in the transitional phase pockets of supply demand excess. I think they are appearing, and one of the examples which I see is that even in essential commodities where it was open even during the lockdown, if you look at the CPI, WPI data, you see clear evidence of supply chain disruptions, of logistic disruptions. So you can see in the CPI and WPI data is that the ratio of CPI to WPI in food has jumped tremendously. And for the 2011-12, which I had a quick look, I didn't go back to the previous CPI data, but you can see that this gap is the highest we have seen since 2011. It's jumped. So to me, that is an indicator of these logistic disruptions, even for a sector. Sorry, this was in May, June, this data I'm talking about. So to, this kind of confirms the forecast we are making, that the government, in a sense, the fiscal policy has to pay much more attention. One can't just focus on aggregates, and we have to focus much more on these disaggregated disruptions. And that applies equally to monetary policy. So finally, coming to monetary policy, I think it's well known, and that this is not special to the pandemic, that financial stability has to be the most important focus of the monetary policy system. But connecting it to what I said about disaggregation, credit policy, in a sense, come back into an own. When we went into this new monetary policy and repo-based issues, I mean, I'm old enough to remember, perhaps many of you are not, 15, 20 years across the world, we thought this credit policy is passé. But in this pandemic, which has both supply and demand shocks, I think credit policy becomes much more important than in normal times. So with that as background, I'm sure on the specifics of inflation and monetary policy, the members of the committee will enlighten us. So let me start with, I think the first listed speaker is Professor ASSOCHAM-EGROW, and she has already been introduced, but I just mentioned that she's at IGIDR professor and also on the PM's Economic Advisory Council. ASSOCHAM?
Thank you, Arvind. So I'll just start by saying that these are my personal views, not those of any institution or body I'm associated with. But I really agree with Arvind. This inflation picture that we are seeing It reminds me of the 2010s where we had very large divergence between WPI and CPI, because we are in an inflation targeting regime, and CPI has been at the slightly exceeding and at the target band for quite some time now. And the latest figures have come in about 6.1, but the WPI is negative at -2%. So there are these sectoral supply chain disruptions that are probably responsible. And the 2010 lesson is that was the time RBI shifted to targeting headline CPI when WPI was negative. And WPI is what is relevant for industry. Therefore, it was a huge, product real rate was very, very high for industry, and that hurt supply. That hurt industrial production. Industrial growth was very low in that decade. So we don't want to repeat that mistake. But I think currently the circumstance is a little different. At that time, you had second round wages rising, and therefore CPI, so there was some point they shifted in the 2010s to keeping liquidity in deficit, durable liquidity, so that the liquidity adjustment was operating in the injection mode. Short-term liquidity was being injected. But today it's
going off. Yeah, okay, you're going off and on. It's okay. Continue.
Huge surpluses in I'll speak slower. Huge surpluses in liquidity, and the prevailing rate is actually below the reverse repo, around 3%, so even lower than the repo rate. And moreover, these inflation figures are unreliable in the sense that they are temporary due to temporary supply bottlenecks, disruptions, which as the unlock proceeds should work out, should disappear. But so my policy prescription is that at this time you should pause. But because your real rates are already negative in terms of CPI, but you should give a very clear signal that you want to look through this rise in CPI, you think it's temporary, and that you are in an accommodative mode, and there is space for cuts in the future. But you're waiting to see how, because it is worrying that various states are imposing lockdowns. And as Arvind was saying, we find that what works is containment, use of masks, preventing large gatherings, but allowing production to take place. So I think that lesson should go through, that production should be allowed to resume, the supply chain disruptions should be allowed to be phased out, and then the RBI can cut further, because then this inflation, the CPI would come down. So, and we have also done some research which shows that in an economy like India, where information is thin, RBI projections and communication really matters for anchoring inflation expectations, along with food prices and oil prices. But all this is going to be, oil prices, for example, are going to be very soft. So therefore, if they communicate that they are continuing to, that they have space and they will cut more, but they are waiting to see that these sectoral supply chain disruptions are alleviated, I think that would be what I would recommend at this stage. But at the same time, they have to work extra hard on transmission, because this is a time when there is uncertainty in markets, and we are seeing that banks are putting huge reverse repo. There's huge liquidity in the system. They are putting this in the reverse repo, but credit is not picking up as much as it should, despite the partial credit warranties, etc., given. And we have seen in the past that when there is such large excess liquidity, as happened during demonetization, it leads to various kinds of risks, like the commercial paper market exploded, and that led to NBFCs borrowing short and lending long, and that led to problems with ILFS, etc. So I think there is also scope for keeping liquidity in surplus, durable liquidity in surplus. Again, our research shows that transmission is much better when it is in surplus. And we are seeing that with liquidity in surplus, transmission has improved. More of the RBI's rate cuts are being passed through. But at the same time, withdrawing some of the liquidity. There is room for reserve money growth to be higher because broad money growth is not as high as it should be because credit growth is low. But still, you don't want it to be excessive. So some moderation can, but at the same time, I think banks have been given a lot of carrots. The entire credit warranty, this credit system, the lender works through banks. And maybe along with the carrots, now you need to give some competition. And I think diversity in financial markets is very healthy. So the focus on financial stability should also go towards acting directly on spreads, the risk aversion, perhaps by encouraging the corporate repo market. This is the time to do market confidence building policies. They've been focusing somewhat on financial stability. So the Khan Committee recommendations, for the RBI to do repo and corporate bonds. The corporate bond market needs to develop as an alternative for bank credit. Because some NBFCs and so on will do better if this market revives. Banks are still not lending as much as they should, still slow. So we want credit growth to revive. So it's a good time for initiatives that would build market confidence. Government agencies are the only ones without fear in a situation like this. And they need to act to improve market confidence as well as the confidence of consumers and firms. So here, I think general people are agreed that the other signal they can give is for OMOs to support government borrowing. In general, there seems to be agreement that you need a big fiscal push, you need a demand stimulus from the government. But the government's deficits and borrowing requirements are already high. So some sort of signal announcing some OMOs maybe to show that they are there to, already the 10-year GSEC rate has fallen, but there is room for it to fall further. And actually, because household precautionary savings have gone up, deposits are rising with banks are increasing their SLR holdings. So there is demand for government bonds. I think the government borrowing program is going through quite comfortably, but still that signal and that the Reserve Bank is there to support would be useful. Now here, I think the other problem for the Reserve Bank is really two kinds of prudential regulations. One is capital flow management, because central bank's balance sheet is already about 35%, government securities, while 65%, it used to, the average last year was about 70 US government securities. So much of inflows are coming in. They have to accumulate reserves to prevent the rupee appreciating too much. And that increases liquidity. So unless they have many capital flow management techniques. They used to say that it's like a line. They reduce, and even the IMF now supports capital flow management. They know that emerging markets have a dilemma. Aline Ray has written on it, that there can be surges and stops which make policy very difficult. So there is scope for using some. So that is one kind of macroprudential that could support the government, help the Reserve Bank support the government borrowing program. The second is that there'll be a lot of demand for moratoria to be, or at least restructuring as the moratorium ends. I think the moratoria should not be extended because we are seeing that as the unlock progresses and some firms revive, then people are repaying this. The percentage availing the moratoria is as low as 6% for some banks, 30, 40% for others. So now, and if there are demands for restructuring, but this should be targeted only, the bank should be left to target this. It should not be blanket. It should be targeted to those firms that are suffering now, but they are healthy otherwise and have a future. So not support unviable firms. And banks should make that judgment. And the second thing is you can support bank lending by counter-cyclical prudential policy. Dr. Reddy used this very effectively in the mid-2000s. Where you change your provision weights on different kinds of lending, etc. So that releases more funds with banks. There is a scope for looking at Basel III requirements. Dr. Charan Singh often talks about this. So to release, because there is regulation should be counter-cyclical. When you are in a slowdown, you want to expand credit growth, you reduce the regulatory imposts on the sector. So I want to summarize by saying pause now, but signal that you have space and you will continue to cut as the supply bottlenecks, temporary supply bottlenecks ease. Then support lending by keeping liquidity in surplus. Act on reducing spreads by market confidence building measures. Increase credit actually use and the giving of credit by counter-cyclical regulations. Use OMOs, announcements, signals to reduce spreads in the market. Yeah, thank you.
Thank you, Professor Goyal. Let me just highlight a few points made. Of course, you made a lot of points. The one which struck me is, the importance of forecasting, accurate forecasting, because communication from RBI matters. And she has pointed to some research. My research also showed that the major problem from the switch to inflation targeting was bad forecasting, which really increased the real interest rate tremendously. It resulted in a huge jump in real interest rates, which had a very negative effect on many aspects of the economy. The second one is on transmission, which again, I think both of us have been emphasizing that the latest research, which I'm glad your own research is supporting that, is that liquidity, sufficient liquidity aids transmission. But I agree with this point, which is a valid and point which should be noted, is that then, just like I was saying about commodities, there would be pockets of excess supply and demand, which is what you're pointing, that if there is excess supply, it can lead to risk-taking, which might not be good for the overall stability of the system. So, I mean, there were many other things which you said. I think one more I would point. So this is very important. I think, yes, absolutely. Even if excess liquidity is good for the system as a whole, the central bank must watch out for pockets where risk-taking may become too high. And of course, the reforms, that perhaps the opportunity is now there during the transition to start thinking of certain things, certain types of reforms or other things which will both aid the transition and set the system up for better things when we are close to normalization. With that, let me turn to our next speaker. I don't have the program in front of me, but if you just go by the program, I forget who it was. Sorry.
We'll go in the sequence of Indranil, then Upasana,
Indranil,
then
right.
Abhi, then myself.
Yeah, okay. So Indranil, sorry, I didn't have the programs. Please go ahead. Yeah.
Indranil, are you around?
Seem to be missing. No, where is he?
I think he had just gone somewhere. Then he said, I'm back.
Okay.
So then probably we could go to Upasana and then come back to Indranil.
Oh, okay. Yeah, Upasana ji, please go ahead.
Sure. Good evening, everyone. Yeah, so I would completely agree with what Professor Goel has mentioned. I mean, she actually talked about a lot of issues. So I will straight away get to the inflation dynamics and how things are at this point in time. So just going by some of the numbers, like until early July, let's say, it was kind of an absolute consensus that we would see further rate cuts in August and maybe even after that. So on an average, there was a consensus across all segments, wherein minimum 25, but it was actually 50 basis or 75 basis of rate cut, which was expected. However, after the release of the recent data, the 3 months data, which came all together in one go, April, May, and June data, we realized wherein expectations were that inflation was hovering in the 5 to 6% range for that quarter. Actually, the real numbers came out to be significantly higher, 150 basis higher than what was expected. Clearly, all of that, like Dr. Virmani said, it has been a reflection of supply side disruptions really outweighing the demand side weakness that is there. And the phases of localized lockdown that has happened after the end of the hard lockdown that we saw, that clearly is just continuing the supply side disruptions more and more. So somewhere in the near term, clearly these supply side disruptions will continue and keep the inflation elevated at least in the next 2 to 3 months more. So above 6% inflation continues. That is the backdrop which RBI will be getting into in April. Even on the core inflation side, if we look at the last few readings, then they have been suggesting, I mean, demand has obviously been nil or absolutely absent. Despite that, core inflation was extremely elevated in the last reading that we saw. Various factors have contributed to that. Gold prices have surged. LPG price hikes had happened. There was a pass-through of excise duty hikes on the petroleum products. All of that seemed to be completely outweighing the otherwise weak demand side price pressures. Having said that, if we look at beyond the 2-3 months, then the second half clearly looks still comfortable, especially the third quarter of this financial year, supported by significantly, I would say, favorable base effect. Clearly, we've seen very high numbers last year around the third quarter. So I would say that the favorable base effect is there. Along with that, some of the supply side disruptions hopefully will ease off as we go forward, and hence the demand side contraction will again outweigh. So we are looking at the third quarter to be probably much more closer to 3%. That is the level of inflation. So just to point out one thing, I think if we look at the 115 basis of repo rate cut that has happened till now over the last 2 meetings by RBI, they have largely been on the premise or other anticipation of not the near-term inflation being low, but the second half of the inflation trajectory being very comfortable. Because even when they cut rates recently, inflation was high. We had the March reading of 5.8%, and prior to that, we had 7% plus readings. So inflation was already high, and yet RBI did go ahead with rate cuts. So clearly, the MPC had, you can say, front-loaded most of the scope that they had in terms of policy, just to address the near-term supply, near-term overall, disruptions to growth that we have seen. So obviously, now that they have front-loaded most of it, the scope looks limited. In any case, even if whether they deliver a 25 basis in August and get over with it, or they pause right now, wait to see how the impact is and then act. So that is a very close call, I would say. But clearly, one thing is there is no denying that the state of the economy requires significant additional policy response. That is not to say rate cuts necessarily, but like Dr. Virmani said, I think credit policy is something which really supersedes right now. And we need to address the credit issues more than the liquidity issues. Liquidity is there now, and RBI has accepted that, and they have ensured that liquidity remains adequate in this environment. The bigger challenge is for RBI to really keep this in mind as to 2-3 things rather, just going back to inflation a little. One is that real interest rates are turning negative, which again, RBI will have to be watchful about from an inflationary perspective. The other, like we just discussed, on the persistence of supply side disruptions. So this is one aspect. But apart from that, the other factors are clearly the risk of various firms not being able to stay afloat because of the credit squeeze. I think that is something which is a very big risk. So somewhere the credit uh, risk in the system that is there, that is, in fact, it's a cause and effect now. So the lending institutions do not want to lend. There is severe risk of, and correctly so, because they have a risk of worsening balance sheets as the period of moratorium gets over. There is no clarity on how and which all firms will survive beyond a certain point. All of this uh, does suggest that the credit risk cannot really go away easily, and we will have to pass through this phase with this kind of a situation. In fact, the MSME scheme, lending scheme, which the government has guaranteed 100% up to 3 lakh crore, if we see, because of the adequate liquidity available with the banks, there has been a lot of traction with regard to this particular facility. So we are seeing banks really going ahead with this facility. They are willing to lend only because the government has come out with a 100% guarantee. Beyond that, the banks are only willing to lend to the best of all the corporates, and there also they've hit a limit. So most of the banks have hit the limit beyond which they cannot increase the exposure to uh, many of these corporates. So there is a problem here of availability of credit to the people who, or to the firms who need, they are not getting. This is also reflected in the bond markets. So clearly we know that it is the spreads of the corporate bond AAA remains very comfortable, especially in the near end of the curve. So I would uh, really agree with what Professor Goel said. I think the repoing of corporate bond is something which the RBI should consider. Uh, we've been saying this for a while now, but RBI has refrained from increasing its exposure, or rather opening up its balance sheet to any such kind of risks. And but I think this is one measure which can really provide a lot of comfort when it comes to the credit risk that we are seeing in the economy, because otherwise we will not find willingness to lend at all in this kind of environment. So overall, the recent obviously high inflation reading has made this decision for a rate cut, I would say, very close call. It is, but like I said, it is a 25 now or maybe another 25 later. It's not there. There's not much room to really ease beyond what we have already seen. But I would say that besides policy rate cuts, because now incrementally rate cuts are anyways not as effective. So again, transmission becomes much more important. And for transmission, again, liquidity is one necessary but not a sufficient condition again in this environment. Apart from that, some of the regulatory tweaks will be important. Ring fencing of the financial sector, very crucial. So again, just by going by a broad-based, like again, what Dr. Virmani also said, I believe, we cannot just go ahead with a broad-based measure. Some one-time restructuring is required for select sectors. We can probably focus on those, but again, not like a broad-based kind of thing, because we need to really ring fence our financial institutions. Otherwise, going ahead, whenever the economy normalizes, it will be difficult to really be back on our feet to really finance the needs of the economy. I would say that one place where transmission could be facilitated again is a widening of the policy corridor. So maybe the reverse repo could be increased a little bit more than the policy rate. So I think right now we have the corridor as 65 basis. We could probably see that increase to 75 basis. Along with that, I think another aspect which we need to keep in mind is that this year we are expecting a huge amount of balance of payment surplus. So the kind of liquidity infusion that we are expecting is massive. So the special deposit facility also, the legal framework is in place. So maybe that too could be one of the tools which could be announced and used as and when required. So the SDF, widening of the policy corridor, these are two other recommendations which I would probably look into.
Sorry, I missed what flows are you expecting? I missed the
balance of payments, sir. So
yeah, right.
right. So this
Yeah,
is
yeah,
a year.
right.
Yeah, this is a year when
Yeah.
current account is likely to be
Yeah.
surplus. So
Right.
overall,
Got it.
Yeah. So from an intervention perspective. Yeah.
Right. So very briefly to highlight a few points. I think the first point, which I think you reiterated and re-emphasized in a way, is the uh, is looking much more carefully at the micro conditions, which Professor Goyal also had said, in terms of individual markets and so on, and reiterated. So I think that's a good issue. Maybe it's time to do more on the repo market, the commercial bank lending market. So I think that's something we should take note of. I mean, you mentioned regulatory tweaking and ring fencing, etc. But I think the overall message is that perhaps we need to look much more again at the opportunities for reform, that this may be a good time. And in fact, I would urge all members, if they think of more specific reforms after the meeting, I would be personally interested in just having a list of reforms which maybe it's a time to consider. Is Indranil back with us? Okay. Yeah, he's a senior vice president and economist for Bank of America. I'm not really introducing anybody, but just to get it started. So, sorry, I had one question which was related to this bad bank issue. So those of you who know from the banking system, if you can comment on it. I'll come back to Pasna. Maybe you can think about it. But if the others want to say something or alternatives, I think again you're kind of indirectly touched on it. But for the general public and others, I think this is an important issue which many are not very clear about. So if you have views on that, we would like to hear them. Indranil?
Yeah, thank you, Dr. Virmani, sir. We are looking at a 25 basis point rate cut on Thursday and 75 basis points more in this fiscal. So 100 basis points more of rate cuts. Number one, we expect GDP to contract by 20% in June and 6% by in this fiscal. This assumes that the current restrictions end somewhere in middle of November and the restart takes December. So we estimate that every month of lockdown is costing us about 100 basis points of annual GDP. And the restart with all the labor dislocations will probably cost us about 120 basis points in terms of 6 weeks. So that's number one. Two, we do not, lose any sleep over the inflation numbers. I mean, of course, we do think that inflation will be 6.4% in July because their tomato prices are rising. But in the second half of the year, we think that inflation will collapse to 2.5% on an average. Number one, like we said, growth is collapsing. And how can you really have inflationary pressures when you have a fall in growth? I mean, there are supply side pressures which will work themselves out. There are methodological issues which is best left to the CSO. But we think that growth is not going to put inflationary pressures. That's number one. The rains are proceeding normally, so there is no reason to fear inflation. If you look at imported inflation, commodity prices are falling. The rupee is stable because the RBI has bought sufficient FX reserves. So you don't see any imported inflation. The fiscal deficit, yes, it will go to 10, 11% of GDP. But bear in mind that growth is collapsing from a potential of, say, 7% to 6% contraction. So, there is very little, evidence that, the fisc is going to put pressure on inflation. So we are seeing a passing phase of inflation, which is due to supply side issues, which should resolve themselves. So we do not see inflation as a remote concern for monetary policy at this stage. The third point I will make is that money supply growth has now, gone to 12.4%. Our forecast for the year was about 9.5 to 10%. 3-4 months ago, we were in a situation of excess money demand. Money supply was always below what could be demanded. If you look at the money demand function, now the situation has reversed. You are in excess money supply. So now you are not in a situation where you can, just put in as much of liquidity as you like. So the last time the RBI paused, yields went up, you did OMO, etc. Now you do not have that luxury. So you have to increasingly of ways to interest rates, non-generating ways to bring down interest rates.
Sorry, just
am I
repeat
audible?
that again. No, there was an interruption. Just repeat the sentence.
So what I'm
Repeat.
saying is that so we have to look at non-M3 generating ways to bring down interest rates. So number one is to cut the RBI policy rate, because now the lending RBI definition, everything else comes down. One. You do not have the line, because it is when the busy season starts. There is no point waiting till it comes down to cut rates, because by then you are in the busy season, so you lose that opportunity. So that's the first point. The second is that as has been also spoken of before, given the fiscal deficit, we are looking at about 105 billion. So there is $80 billion of surplus in the market. Fiscal deficit requires $105 billion of balance of payments. Say that the RBI should be able to buy $45 to $50 billion. I think one way to reduce the OM component is to extend the HTM facility for banks. The reverse %, or you can G6 at around 6%. So, on the first G6 is that the banks can face very large MTM hits. So to give banks that comfort, if you raise HTM, then a lot of banks will be buying G6, and you don't have to generate primary liquidity reserve money by doing OMO. The third is that you could buy FX in forwards, and that again will keep the FX below the line and not generate M3. So net, for the policy purpose of this meeting, we are very, very strongly in favor of a 25 basis point rate cut right now, and 75 basis points more through the year, given that our base case is that there is going to be a 6% GDP contraction, and in case the world has to wait for a vaccine, that could also go to 7.5%. Let's stop here.
You were disturbed again. Can you just repeat just quickly the three methods you were suggesting? HDM, forwards, and one more I missed.
And cutting rates, because lending rates, retail and are linked to the policy.
Okay. Yes. Okay. So a couple of things. I think you have come out very strongly on cutting the rates. An important point which you made earlier also in previous discussion, but I think important again, is that there's no point waiting till the busy season is over. This is the time when it will have a positive effect, if that's what the objective is. I think that's a very important point which everybody should think of. Very important that you brought it up. And of course, the capital inflow, Upasana had pointed out, but yes, you are reiterating that issue, and management of foreign inflows is obviously going to be important. I'm reminded that I think in my January meeting, I had warned Governor with the economist we were having with him, that there would be a huge, this was before the COVID, inflow, capital inflow into India. I think because of COVID, things have got a little disrupted and it's a bit uneven. But yes, I had forgotten, but my own forecast. But I think it's good both of you are reminded that could still happen during the current year. It could get swamped by capital inflows, and their management clearly will be a very important, should be a focus for RBI. Yeah. Okay, so let's see if I can find my program. Yeah, okay, so let's move to the next speaker, which will be
Abhik Baru.
Abhik, yes, sorry. Abhik, Chief Economist and Executive VP of HDFC Bank. Yeah, please, Abhik.
No, am I audible?
Yeah, we can hear you.
I just wanted to make a short point on how I am looking at both transmission and credit
Abhik,
growth,
Sure.
Abhik, can
what
you
we are
put on
seeing
your
at the
video,
bank.
please?
And I
Your
think this is an
video is not
experience.
there.
Oh, sorry. Okay.
Yeah.
Am I visible now? Yes.
Not
Can
as
you see
yet.
me?
No.
Okay.
Yeah, we can
Okay.
see.
All right. Let me restart. And
We just
Okay. Let me restart. If I'm both. I think one of the things that has kind of puzzled me and I think bankers in general is that although credit growth has come down, if you are indeed looking at a complete collapse in underlying growth in 2 quarters, then where is the credit growth really coming from? Because you should see, if not as big a collapse in much below the kind of numbers that we've seen. So the latest credit growth number is about 6%, and you're talking about an underlying degrowth or contraction of 25% in the first quarter, 11 to 12% in the second quarter. And broadly, if you look at the relationship between nominal GDP growth and credit growth, they move, they are sort of one to one. So if nominal credit growth goes up by X% over a particular year, then credit growth tends to go up by X% plus or minus delta, depending on the levels of intermediation and so forth. So I think the point is that if this year is going to end with a degrowth or a contraction of 7 to 8%, you add inflation to that of say 4 to 5%, you're going to get nominal GDP growth of between -2 and -3% in the best case. So, and if indeed between nominal GDP growth and credit growth does hold, then you're likely to see, now that credit growth is 6%, you are likely to see considerable decline in credit growth rates going forward. And the second half is likely to see significant contraction in credit growth. This, as a bank, we started noticing. And my submission is that transmission will happen because so let me address the issue of why we did have a credit growth number in the first half, which was kind of decoupled with the underlying GDP growth. It's because a lot of the bigger companies, the less risky ones that banks were willing to lend to, really front-loaded their investment, their borrowings. They build large cash chests, and for them, their borrowing is pretty much done for the year. Banks moved a little down the risk ladder, willing to lend to, say, double A companies, but there too, there's been considerable front-loading of credit demand. So once that then starts dropping off, we are likely to see credit growth coming down. And through the simple sort of demand supply mechanism of interest rate determination, I think interest rates offered by banks will start to go down. So I would see transmission emanating from the decline in credit growth as banks offer lower rates in order to get the very sparse range of credit opportunities that are available to them and drive interest rates down. So I think you will see going forward a period in which you transmission and transmission picks up, but credit growth keeps declining. And given the causation, that's the way it is running. So I think this is perhaps a period in which the RBI should pause, given some of the concerns. I don't think this is a long-term concern, but as Upasana pointed out, there is a short-term concern about inflation and the optics of cutting rates when inflation is over the tolerance limit can be a little, can raise a few eyebrows. There is perhaps no need to rush things. I do believe that we need to cut a little more, but perhaps the RBI take stock of what is happening to transmission, take stock of where liquidity is going, where it's reaching, whether sector-specific micro initiatives, as some of the previous speakers pointed out, can be used to channel the liquidity into funds or credit for sectors, and so hold, but clearly give a guidance that they are not done and dusted, and there is certainly a possibility of cutting rates further going forward. And I think there is reason to pause because I think we are moving close to what could be the lower bound for our repo rate. There is a point below which, given underlying inflation, the structure of the economy, the structure of money markets, below which the repo rate cannot be brought down, say maybe 3.5% or whatever. And I think, given the kind of problems that we're beginning to see in the economy, which is greater dispersion and diffusion of the infection, and that's spreading to states which are vulnerable, states like Bihar, Uttar Pradesh, who are possibly at the beginning of their infection cycle, it is possible that we could see more severe or continued lockdowns in states which would affect supply chains, which would affect growth, and so forth. So once that, if that were to happen, you need to keep your powder dry to perhaps send another round of signals that you're willing to boost growth. I'm assuming here that there won't be a large fiscal package coming through. In terms of a couple of specific issues that I wanted to mention, one was that, and this is with regard to what Dr. Virmani said right at the outset, that we need to think of this as credit policy and how to get credit across to the real economy. And although Upasana that with guarantees being given to banks, they are more willing to lend now to the traditionally risky sectors like the MSME. If we go by sort of consensus estimates of bankers of how much of the 300,000 crores that have been guaranteed in the largest credit guarantee package, only about people are expecting at most about 1,50,000 crores to go through. The question is, how do you use this guarantee? How do you prevent the guarantee going waste and deliver credit on the back of this guarantee? I think what needs to be done is to increase the ambit of potential borrowers who under this guarantee, bring maybe larger companies in, bring other segments in who are eligible for this guarantee, and at least ensure that whatever the government has committed, fiscally in terms of, protecting loans, actually translates into loan delivery. So this is one to be addressed, in the near term. And I just hope that the credit policy has something to say about it, although it is strictly in the finance ministry's domain. I completely agree with Upasana and Indranil that with the kind of forex inflows that are coming in, and with the kind of extant liquidity there is, oil be a bit of a problem. But so we'll have to think of ways around it, maybe more twist operations and so forth, perhaps required. For the final point that I want to make is that to go back to what Dr. Virmani said right at the outset, is that this is both a demand and a supply shock. So it is unique in that sense. And the assumptions that we often tend to make are based on a reading of a shock, either as a pure supply shock or as a pure demand shock. And there could be a misreading of this as a pure demand shock, and which would lead us to expect inflation to come down very sharply, because if there is a demand shock, there is contract demand, prices cannot remain high. But this is a different animal altogether. It has this combination of supply and demand problems woven in. So going forward, it is likely that we will continue to see demand-supply mismatches in certain areas, and that could lead to blips in inflation, maybe a sustained elevation in inflation in some categories, and so forth. That is the nature of inflation that the RBI will have to grapple with, which is volatile, perhaps in terms of trend headed down, but volatile along this trend, and how much they look through some of these upward pressures, and how convincingly they can convey this to the market, the decision to look through, is, I think, an integral challenge of monetary policy going forward. Thanks.
Thank you. Just highlight two points. One, of course, I think very important analysis of credit, where I think we'll have to watch out for the point, very important point made, that in H2, there could be a collapse in demand and an excess supply of credit, which will naturally push down competitive market loan rates, and therefore appear as a better transmission. But certainly all the implications of this we need to all think about. The second one, this operation twist, I think I've heard this. I think it's important to again think of that issue and watch both the long-term rates, because at least going into the normalization period, I mean, it may not matter much in the transition period, where really not too many people are thinking of investment. But certainly going forward, this could be an important issue. So definitely worth thinking about beforehand. With that, let me move to Professor Dr. Charan Singh, CEO of EGROW. I think you're next on the list. Yeah.
Yeah. So thanks for this opportunity. I think much has already been said and different segments have already been covered. That makes my job much easier, so I can come to my recommendations a little faster. I have a feeling, and going by the experience of the Indian economy and the story of the lean season and the busy season, I think if the lockdown gets over sooner, say 31st of August, as the busy season starts, things start improving and recovering and recouping and bouncing back much faster. Even during this period that we have been witnessing, as you know, agriculture has not been impacted. We have had a good Rabi crop. The monsoons are doing well. Kharif is expected to be good. In addition, defense, banking, insurance, police, government has been working. Education has also been working. Online classes are almost everywhere. And IT, people have been working from home all across. The pharma industry is doing very well. Medical equipment is doing very well. And automobiles have already started back into their factory. So the point I'm trying to make is, even if I look at the IIP data or the 8 core industries data, the recovery that they staged in the month of May vis-a-vis April, and my own feeling is that in the month of June, July, and August, the recovery on these sectors is going to be significantly high. I am thinking that the thought that the lockdown meant that there was hardly any growth may not be the right conclusion. To some extent, yes, I would say 20 to 30% growth shaving might take place, but about 60 to 70% of sectors have been working. And therefore, when in the busy season we relax the lockdown, and even if we come back the Bangalore style for 10 days or we do it the UP style weekend lockdowns, I think the production is going to take place. So I'm not pessimist or not that pessimist that the growth will go into that negative zone in a significant way. Having said that, I'm also of the view that the migrants which went back and are surviving on Manrega now, which is 200 rupees a day, will immediately come back when they know that in Bangalore the minimum wages is 800, in Delhi is around 900, and little skill gives them about 1500. So I think the Manrega is not going to hold them back. And once they come back, we will have life as usual, or may not be normal as normal it was in the month of October last year, but certainly better than what we are seeing. On inflation, I totally agree with Indranil. If you look at both the components, the indicators that we have, the WPI and the CPI, it is the potatoes, the tomato, the pulses, the meat and fish, eggs, where inflation is rising. And this is going to be, these are of course very seasonal and going to get sorted out. So I do not look at the inflation in terms of 6.1% general and food as 7.87. I think it's far more benign once it settles down. So for the repo rate to be comparing with the inflation and looking at the real repo, I think one will have to be a little more, one will have to take this into account, a little more nuanced analysis. Now, the question that has been raised before I move on to my recommendations about the bad bank. I think in this time of crisis and the situation that we are in, having a bad bank is a bad idea. And therefore, there will be lots of desperation and urge to clean the balance sheet and move things out of the bad bank, move things into the bad bank. I think that will not be right in the medium to long term for the banking industry. So that has to be avoided. As far as the point which was made by my previous speaker, Madam Upasna, I totally agree with her that the crisis and the difficulties out there in the industry are tremendous. Therefore, the NPA story is also very, very uncertain at this point of time. Though the Reserve Bank has made a prediction that the NPAs may rise from 8.5 to 14.7, but where are those sectors? It's very difficult to predict right now. As I just mentioned, some of the industries are doing very well, but then we are all aware there are sectors which are not doing that well. So the banks will have to be ready and will have to have that resilience to handle the uncertain NPA levels which are going to come on their shoulders. The liquidity part has been taken care. I'm not sure about the solvency part. And especially when we are going to come to Mr. Raman Agrawal, who's going to speak after me, the solvency part is a cause of concern, not only in the areas where NBFCs extend, but even in medium and large industries. The point that has been made on credit growth, as we all know, the credit growth has suffered tremendously. The rate has come down from nearly 11, 13, 10% to 6%, which is very low. But then the issue is, now this is where even I'm not very sure, but then the issue is, in these times of difficulties, would you like to avail credit or would you like to pause and see until the supply starts and demand comes? Now that is what brings me into my recommendations right away. I think the repo rate has to be accommodative, given that the lean period is almost over. The busy period is one where we need to recover and recoup. The repo rate, as of course done in advanced countries, much lower. And I totally agree with Mr. Abik, who says there has to be a threshold level in the Indian context. You can't go below that. But I have a feeling the repo rate can go till about 3%. It's already 4. So 100 basis reduction would be legitimate and would also convince the industry and the market that the government and the RBI are serious in their endeavor. To wait till the busy season comes, I think is too late. If it has to be done, it should be done earlier on and front loaded. So I would say it is good to do a 50 basis cut right away and a 50 basis little later. But by the time we are in the middle of the busy season, the interest rate, the repo rate should be sufficiently low. Not only low, I think forward guidance is a must at this stage. If you look at the other countries, they have almost given the forward guidance that for the next 18 months, they are in the low interest rate regime. I think that's exactly what we will have to quickly do and tell the local industry, which is in distress, that here we are accommodating it. Of course, the reverse repo rate, I think, is still very high. Parking money at the RBI is pretty productive this time. I think the banking system has to be told at this crucial time, they have to extend credit, they have to identify places where credit can be extended, and they cannot park money at the Reserve Bank. I understand the balance sheet problems of the commercial banks, and the regulator supervisor has to keep and maintain that stability for the financial system. So therefore, I understand that the reverse repo rate can't be reduced to 0 or can't be taken into negative zone. I understand that. But I then totally agree, and I would go a step forward with what Ms. Upasana was suggesting, that it has to be much wider. And I would say the reverse repo rate has to be much lower than where it is pegged now. The third point I want to make is, given the circumstances in which the country is, the IT regime has to be given a pause button. The inflation targeting regime has to be very clearly said that the IT regime is having a pause button. We are looking at growth now. The Reserve Bank as well as the fiscal authority has to reset its button, and I think the growth has to take all the priority because we need to recover growth. I also feel the circumstances in which the country is, the tax regime, the industrial output, the fiscal authority may have to seek accommodation from the Reserve Bank in terms of monetization of deficit. And therefore, the Reserve Bank should prepare itself and have a roadmap in case it comes to that. How are they going to address that issue? And one, I think, has to start thinking about that. The next recommendation that I would like to make is, if you look at the Basel norms, they're far more conservative, and the whole thing weighs on conserving the capital and risk weights. In the present regime where we are, we will have to be expansionary, both on the monetary policy as well as the fiscal policy. If we have to be expansionary, the banking system plays a very important role during these times. And therefore, I think the Reserve Bank would be very much in its place to say that the Basel norms are being given a pause for some more time. They've already done it. And of course, it has been done at the end of Basel itself. But I think the Reserve Bank should take a little bold stand and say this is the time when Reserve Bank is extending the Basel norms. Because when you are imposing Basel norms, capital is expensive, risk weights start playing a story, and this is exactly what happens then. The money comes and gets parked under reverse repo. So I think the banks will have to be encouraged to go out and take some more risk. In addition to relaxing Basel norms, I think it will be in the fitness of things that the risk weights are also assessed. At this point of time, India's risk weight system is far more conservative than the global held Basel norms, and the Reserve Bank may like to consider those too. I wanted to speak about the NBFCs. I think it will be in the fitness of things that the Reserve Bank revisits the whole story of the NBFCs. And the NBFCs to me look like a black box. They need to be categorized into government NBFCs, the large systematically important NBFCs, and the other NBFCs. The government NBFCs certainly are safer. The systemically important NBFCs, some 60 or 70 of them, they need to be looked deeper because they have taken lots of money from the banking system, and because of them, the banking system sometimes sags. So it will be good if the Reserve Bank looks or sets up a committee to look into this 60 or 70 NBFCs, which are private but large in size and can cause little severe damage to the banking system. Other NBFCs, of course, are a different ballgame and they can be treated homogeneously. I'm not going to spend more time on NBFCs because we have Mr. Raman Agarwal and we were together in one seminar where we spent 2 hours discussing about NBFCs, and I've requested him to come and present his views, and he'll take a few minutes. If Dr. Virmani, the chair, permits us, I'd like to invite Mr. Raman Agarwal to come and present his views for a few minutes.
Yeah, sure. So maybe he can also tell us about the solvency and NPA type of issues and what solutions he envisages. Okay.
Sure. So, Mr. Raman, just because of the time, I hope
Yeah.
brief. Mr. Raman.
Yeah, thank you, Dr. Charan Singh, and thank you, Dr. Virmani, and thank you, ASSOCHAM, for this opportunity. Yes, I think a lot has been said about NBFCs. I quickly run through 2, 3, 4 important points. To begin with, was yes, this whole issue of moratorium became a big confused kind of a situation when it came to NBFCs, because yes, we on one side we had to give moratorium and we did give moratorium to the borrowers, but getting moratorium from our liabilities from borrowings from banks and other institutions is still a question mark, and it is not easily forthcoming. That apart, I think I agree with what Madam Ashima also said, that going ahead, I think moratorium extension is certainly not the answer. The situation would be better if you could look at one-time restructuring. Simply a small borrower may not be able to pay 100, he may be better off paying rupees 30. So moratorium means he pays nil. So I think a one-time restructuring with yes, sufficient safety caveats is something which is a preferred option. Coming to the point which was raised about the emergency credit guarantee scheme, let me point out 2 quick points I think which need to be addressed, and it can take off tremendously, because we are currently witnessing NBFC's contribution in this part not very significant. I see 2 reasons. One, the kind of lending which NBFCs do, currently the individual borrower segment is outside the purview of this scheme. So only if I have a proprietorship form and I borrow in the name of that proprietorship form, I am eligible. But if I borrow it in the name of my individual own self, I am ineligible. So I think that is something we have approached the government that needs to be tweaked. Secondly, the scheme restricts to the quantum of lending restricted to 20% of the total current outstanding. So that means existing borrowers, whatever outstanding is there, only 20% of that is covered. If that is tweaked, I think both these points then can increase NBFC's contribution in a big way and also expand the scope and the reach of this scheme. Now coming to the all-important point of the liquidity part. Well, sir, while a lot has been done and a lot has been said about liquidity coming to NBFCs, whether it was partial credit guarantee scheme, But I'm sorry to share once again that the story remains the same. It's like once again going to that handful of NBFCs. So the whatever liquidity is flowing, it's still going to that segment of, I would say, 100 odd top NBFCs who are big in size, maybe highly rated. Now, to the larger universe still continues to struggle. Quickly, I'll make 2-3 suggestions which we have already suggested to the government. One, all the small and medium-sized NBFCs do not access capital markets. For them, still the mode of borrowing is by way of simple term loans raised from banks and financial institutions. All the schemes, whether it was partial credit guarantee scheme or the special liquidity window, they target about banks investing in the bonds or the papers issued by NBFCs. So small NBFCs are simply out because they don't issue bonds, they don't issue commercial papers. So for them, the mode of borrowing is only term loans. Second, of course, is the issue of credit rating, which small companies are not able to get. But let me quickly borrow from, sir, if you know, the currently World Bank in its development policy loan of 750 million US dollars to Government of India for MSME lending has identified NBFC as one of the strong pillars. I would like to read one very important recommendation and part which the report talks about. It says that the public development financial institutions serving as quasi lenders of last resort to NBFCs can be served as highly relevant examples for India due to its large NBFC sector without a dedicated lender of last resort. So what we are saying here,
இது கொஞ்ச நேரம் ஆறணும். நான் எல்லாம் வச்சிருக்கேன், தேங்காய் மட்டும் சுத்திட்டு இருக்கேன்.
so what we are saying here is that, as was said, let us not be totally dependent on banks. There needs to be a financial institution which can look up at refinancing NBFCs and by way of term loans. So this could guarantee fund flow to a very larger universe of NBFCs. That's my quick point, sir. Thank you. And answering to Dr. Vermani's point on the NPAs, let me read this. The way we look at in the sector about this issue, we don't see, we may be seeing an increase in NPA, but I don't see a situation going to an alarming levels, because the feedback we are getting currently now that in terms of collections, June was pretty good. Although July, again, as has already been said, the reasons seem to be because of, once again, some of the states going into lockdown is causing some ripples. But we don't see a situation where the asset quality would see a very significant downfall. That is for sure. Thank you.
Okay, thank you. Charan, if it's okay, should we open up to questions? See if there are any questions. I think we have gone over our time, but we can take a few.
Yes, but Indranil was raising his hand.
Acha, okay, yeah, sure.
There's something. I think.
Yeah, Indranil.
Okay, the short point I wanted to make is that, everyone is talking of negative real rates in terms of the policy rate and CPI inflation. But the fact is that, the real lending rates are still very high. So if you benchmark against March 2019, while, the nominal MCLR has come down by, about, I think, 130 basis points, the real MCLR has gone up by 45 basis points still, because, core WPI inflation has collapsed by almost 200 basis points. So, to buttress the point Dr. Virmani was making, that, there's a wedge between CPI inflation and WPI inflation. And, when you're looking at purchasing power, pricing power of companies, that's clearly, far lower as the WPI or core WPI number suggests.
I want to just make one point which keeps coming up in most of the that if the repo rate is reduced, if the repo rate is reduced, obviously the deposit rates will be reduced. And if the deposit rates are reduced, then one segment of the society, which is the elderly and the pensioners, their rates will come down. This is the argument which I hear all the time. I want to share my thoughts, and maybe the panel can help us. My own feeling is, in case we are worried about senior citizens, some subvention can be given in their accounts. As it is, they get 1% higher than the rate of interest which others get. So the sort of holding back or hijacking the overall interest rate regime in the country by just saying that the deposit rates will fall down and especially the senior citizens will be hit, I don't think that is a cogent argument and that should not be upheld. One can
Yeah, I think, yeah, Charan, I agree with you. That's perfectly fine. Let's go on. I think we'll take a few questions. That is correct. I agree. I'm sure many would agree that if you want to subsidize, it's much better to do it directly and not hide it and destroy the whole financial system. Okay, so do we have any questions or should we kind of conclude? Are there any questions?
There's some questions on the chat.
Oh, to Professor Goel, right? There's one question. Who's Charan? Perhaps you can read out. I don't know. There's some questions on the.
He who says that moratorium is not desirable, blank moratorium, it should link to verification of available liquidity. Otherwise, masses may take as a gift. And then there are some questions. Will further cut in repo by 25 basis point and cuts in near future? One implication can be on deposit rates, which can fall, which we have just discussed. If the deposit growth falls, banks will have less funds available for lending operations. In such a situation, how can small players like MSMEs meet their requirement for whom deposit tend to be a key source? Big firms can even raise from the market. Well, my answer to this would be that there's already so much of money lying with the banks, and with less avenues available, deposits in the commercial banks have increased. The credit has not. So there's, in that sense, a savings glut which has taken place. And then there is another question. There is increasing aggregate demand is the key, and this is from Professor Anandu Sanyal, who's from Giri Institute. And his question is, increasing aggregate demand is the key, rest will follow. I think that's an observation. And there's a question from Ajay Kumar. I want to ask about lower interest rates. What would be the future impact? Are we following European market? That's another question. So I think some of these questions are more like observations. And if everybody agrees, and just because of paucity of time, we can.
So I think we are well over our time. So if, what we will do is we can go around if anybody wants to give their concluding observations from the members of the committee. I don't know. Actually, this system is slightly, we should have the members separately from everybody else. I can't see who all are here, but let's go down the list. Ashima, if you, Professor Goel, if you want to.
Yeah, I'll just address a few of those questions and some observations. First, I wanted to start, Abhik's prediction that credit growth will come back. Now, when you look at data on the Indian economy, we see that credit growth here is pro-cyclical. It rises while most other countries is counter-cyclical. So credit growth rises and leads growth. So when, as you said, talk about credit policy, or as Upasana was saying, you need to see ways in which credit growth can increase and our in this period of QE, our banks, our households and firms have the lowest leverage in the entire world. I mean, our credit conditions were tightening. So in a way, we are ripe to reverse them. And I think that many of the problems in banks were being sorted out. Net NPAs and PSPs have also come down. So find ways in which to reduce spreads that will increase demand, as well as induce banks, maybe reducing the reverse repo rate so their alternative is even lower, so that they are pushing more credit into the economy. Yeah, how to make them take more risk. Credit warranty is one way. Then I agree that I agree with Charan that the growth predictions are too overdone, because those measures. For example, if you're looking at mobility, you don't see home service delivery and home delivery of foods. So there are substitutes. there is a section of firms that is doing very well, and our measures underestimate those. So it's not really true that growth may not collapse as much as many of the forecasts that we are seeing. And then, but at the present situation, I think what you started with, this lessons of how to deal with COVID, because these spikes are coming, that is very, very important. If we can convince the states that these lockdowns don't work, especially weekend, 1-day lockdown, 2-day lockdown, is very, very disruptive for industry, that there are signs that this is disrupting supply chains. In June, there was greater recovery than there is in July. So, and then if you see recovery in the supply chains, because you need to give a demand boost. As an economy, we cannot give unlimited, even a fiscal spend. Spend can't be unlimited given our deficit, and we can't afford 30% of GDP like the US is their first round and they're expecting another round. So our demand boost has to be given when where it's most effective. So I think cutting interest rates, again, estimation suggests that interest sensitivity of aggregate demand is much higher than it's thought to be. For example, now we're seeing public transport people are worried about. They're buying more cars. We're seeing a recovery in the automobile industry because of this. So lower interest rates can help consumer durable purchase. Again, work from home, there's more demand for residential housing. Again, lower interest rates can help. But at the same time, if these supply chain issues and blockages, the sort of sectoral restrictions that are raising inflation, a signal should go that this should be overcome. So I don't know if 2 months you're waiting and you're saying you'll do it later. So I would still like to stick with the pause now and then a signal, and work on those transmission channels, reduce interest rates that banks are charging consumers, rather than the repo rate itself, while you reduce the reverse repo rate, perhaps, so that you give, banks are forced to lend rather than park with the RBI. And then there was a question on what channels of growth. So as I said, this is that you see, and then I see the main kind of responsibility of monetary policy now to support a fiscal spend, to be there to reduce, to give a signal on OMOs, to reduce OMO rates, to reduce borrowing costs for government, and encourage. We need because when you are cutting rates, if households more, they don't spend. So the most effective kind of highest multiplier currently is government goes in, it has to spend on medical, so infrastructure. And so the ex-ante deficit is much larger than ex-post, if there, to the extent there's a recovery. So help, make it easier for government to spend, to borrow and spend. And then finally, one point I wanted to make about the signal, that again, research shows, earlier there was this issue of headline raises core, but that is only if there are those second round wage effects, which are not there in the current conditions. So it's more about headline will converge to core, which is expected to fall because demand is soft. So the signal should be that inflation is only temporary, and some way to tell governments that they must work on these supply chains. And then the RBI is there to cut rates further. Yeah, thank you.
Thank you. If Vasna is there, any last comments?
No, I would totally agree. I think we just need to ensure that there is much more smoothing of the supply side disruptions. So probably less of the RBI actions and more of government actions, which are much more important at this point in time. And again, while a 25 basis is what I call for, not sure whether, like I said, not sure whether it's going to be August or October, but I don't see rate cuts little differing from the other panelists probably, wherein I don't think at this point in time reduction or aggressive reduction in rates is really going to boost demand. There is uncertainty with regard to wages, with regard to income, and that amount of fear will keep savings higher than consumption. So I don't think we will really see that going. So to that extent, I don't see stimulation on interest sensitive. Yes, there is a behavioral shift which is happening, because of which two-wheelers, entry-level cars are getting a benefit, but it will fade off. That is just a temporary pent-up demand. But there is no consistent increase in demand. So I don't see interest rate cuts from here as much a booster to demand than other factors which will be more important, which is a surety, and hence the government plays a much bigger role. That's what I would say.
Thank you. Indranil? Indranil, are you still there?
Yeah. So just to say that, I think that the RBI should cut 25 basis points on August 6th and 75 basis points for the rest of the year. As everyone has said, the inflation numbers, the inflation spike is temporary, and monetary policy, by its very basic definition, should at least look beyond 1 or 2 months. And when you look beyond, clearly you're seeing inflation go down a lot because of base effects, good rains, low demand, whatever factor you look at is signaling that inflation will go down. Again, will say that there isn't much point waiting because the busy season will be on us. If you were to cut, why not cut early? And finally, when you look at real lending rates, like I said, they're still higher than they were in 2019, March 2019. And therefore, you have to have more rate cuts to bring them down. And now that the lending rates and the RBI policy rates are linked for up to medium enterprises, right? SMEs, retail, and mortgage. The best way to bring down borrowing costs is to just cut rates because their liquidity is in this.
Thank you, Abhi.
Abik has just left.
Okay, so Charan, you want to give concluding comments before I conclude it?
Yeah. There are 2 points which I want to make. One is the last time the world had seen a pandemic like that was 1918. At that point of time in 1918, there were not even 24 central banks. After 1918, the pandemic, which took such a heavy toll, all the countries had a central bank. The quantity equation on which all of us depend is hardly 100 years old. So my point is, this episode that we are passing through, the world simultaneously is passing through, the monetary policy needs a revisit. And signals of this revisit came in 2008 when the world started saying it's just not the IT, probably it's the financial sector which was neglected all this time, and IT was just putting on the bleakers, and therefore we could only concentrate on IT and the other sector went out of hand. I think a time has come when we need to revisit the contours of monetary policy, the objectives of monetary policy. So I think this is a turning point. India being an important country as an emerging country and in the galaxy of nations much different from Russia and China, we need to have a committee to relook at the monetary policy once again and its objectives in the context of India. The last point I want to make is, I think, and I just want to stress that point which I've made earlier, the Basel norms for India and the risk weights need a revisit. Dr. Virmani, there are 2 questions in the chat box only asked to you. I would like to read them to you. So one of it is, what do you think would be time frame by which interest rates would start going up, or are we in a low interest regime for a long haul? That's addressed to you. And the other one was, please constitute monitoring mechanism on the corporates that have taken TLTRO funds should ensure that they are paying their vendors on time. That's an observation. The last question again addressed to you is, agreed aggressive reduction in interest rate won't push up demand. So you would like to.
Okay, so very quickly, I think both India and the world is now in a deflationary environment. I think the capital inflows are resuming. In my view, and I think view of many of the members of the group here, really the time is really not there to worry about aggregate inflation. As I keep repeating, that there are going to be pockets of supply-demand imbalance, and that is really what we have, and that applies not just to goods and services, but factor markets, including credit and money. And really, during the transition period, before we get back to normalcy, we have to actually, we meaning the monetary authorities, the governments have to keep focusing on these. In my view, and I'll be a little stronger here now, that focusing only on the aggregate picture is actually an evasion of responsibility. It just will not work. It has not worked anywhere in the world. This is really a justified, we should not stand on ideology, whether it's monetary or fiscal policy, and do the hard work of looking at the disaggregate micro picture. So how long will that last? I don't see this changing for a couple of years because the capacities are there. The past pandemics, really there were a lot of deaths. I mean, Dr. Charan Singh referred to past pandemics. There were millions of deaths. There is no question of getting anywhere closer. So the supply ecosystem is not destroyed. It is just disrupted. It's a question of minimizing this disruption and therefore minimizing the risk. If you are able to do that successfully, the economies will go back to normal. And then we can start thinking about, as far as the payment question is concerned, it's really many of us, I'm sure many members here have talked about that the simplest and most easy and important way the government can help things is by clearing its payments, because it's just a matter of shifting it. It's not a question of whether you can afford it or not. You have outstanding payments, clear them. That is the best way the governments can do, and they can borrow. That's the whole point. Whether it requires monetization or not, I think certainly, I'm sure the RBI is considering. I think it's a matter of convenience. As far as monetization is concerned, they have to see what effects it will have. But effectively, I'm sure that RBI is coordinating with government to ensure that there is no shortage of funds as represented by spikes in the basic benchmark rates on which the economy runs. I think it would be a disaster if the benchmark rate, which is generally 10-year government securities or something like that, if it spikes up. It needs to remain at least as low as it was a year ago, which was not very low. So I think that was the questions. Let me just close. In fact, most of us have gone back to where we started. As I mentioned, the problem is that it is a period of huge uncertainty. We have been seeing that, which is something I said on an earlier discussion, was that, when I started hearing international experts, the best ones in February, March, April, always used to start by saying that it's big uncertainty. We can't say for sure, but if you insist, this is what we see coming. And all those things have been revised. So that's the basic thing we should not forget, that in this, till the period of transition is over, there is huge uncertainty. So I would not be ideological about it. I would not be stuck on one recommendation. We've had a variation, a lot of across the board. And I think every judgment is kind of as good as any other, given this huge uncertainty. But coming to the government side, though this is a section on monetary policy, I think that the lessons are now much clearer. The uncertainty about how to manage the COVID is less, but the knowledge is still not being incorporated in many governments. And I don't mean only our state governments or perhaps even the union government, but countries across the world. They are not fully incorporating the lessons from COVID, which we have learned over the last week. We didn't know these things in March, but we know a lot more. And really, it is very important. Otherwise, we are going to have this stop. We have to incorporate this in the de-lockdown or de-containment process. Otherwise, we'll have to stop-go processes, which we are seeing across the world, which are itself creating uncertainty. So really, I think frankly, even though we are discussing monetary policy, the monetary policy, in my view, during the transition period is actually secondary and has to be supportive. I think somebody has said this earlier also, has really to be supportive of the fiscal policy, which we must insist improve and incorporate the scientific lessons which have been learned over the last 4 months. Anyway, that's a general statement, but let me finish with that. I think we've gone half an hour over our time period. Thank you to all the listeners and all the participants who stayed with us for 2 hours. It's been a long session. Thank you all.
I would like to thank everybody on behalf of ASSOCHAM and EGROW Foundation, all the participants who have been here, and all the panel members of the EGROW Shadow Monetary Policy who have taken time to be here and share their thoughts.
Very